I think it's terribly important to understand that the purchasing or the value of gold and its purchasing power generally varies very, very little over considerable periods of time. And any variation in value in the short term is probably as a consequence of shifts in the valuation for the paper currencies in which it's measured. I think things are going against the dollar, and that is the most important point to understand. And if people can really grasp that, rather than thinking that gold is rising, then they're halfway to understand what the future is for the dollar, and therefore how that is reflected in the dollar price of gold.
Gold is poised for record highs in 2024, bolstered by dovish U.S. rate shifts, geopolitical tensions, and central bank buying, with spot gold already up 13% in 2023. Alasdair Macleod, Gold Money's head of research, is optimistic about gold's prospects in 2024. Macleod underscores the broader implications for the U.S. dollar and highlights its influence on gold prices. According to an analysis by the World Gold Council, gold outperformed emerging market stocks, U.S. bonds, the U.S. dollar, global treasuries, and commodities in general. As the strength of the U.S. dollar rises, gold prices tend to dip. This is why many gold investors keep track of the U.S. dollar and foreign exchange, Forex rates. Alasdair Macleod foresees stable gold prices due to weakening paper currencies, distinct from the fluctuating dollar. He states that the value of gold anticipates the decline in paper currencies' purchasing power. The link between paper currencies and gold provided some assurance that paper money would not lose its value. Macleod stresses gold's status as money rather than credit, highlighting a limited understanding influenced by the U.S. Treasury. However, he hints at central banks accumulating gold, with some countries discreetly incorporating it into funds. According to the 2020 Central Bank Gold Reserve Survey, central banks have cited one of the top reasons they are holding onto their gold is because of the precious metal's performance during times of crisis. And 20% of them are looking to increase their gold reserves over the next 12 months. Surprised by gold's year-end resilience compared to silver, Macleod highlights silver's decline in a tight market. Meanwhile, silver prices are also expected to remain in a range and trade sideways this month. In the international market, the $25 level will be an important level to watch out for, and only a break above this can trigger a strong up move. Now, we present the clips of Alasdair Macleod's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I was very surprised that the price of gold held up so well right into the year end. Silver was less so. That was interesting because that is a very tight market, and they did manage to move that one down, so much so that actually on the year silver was unchanged, which from the point of view of year-end valuations would have been extremely profitable for the dealers in the bullion banks. So perhaps that's where they made their money rather than in gold. Now, having said that, the outlook for gold, I mean, there's no doubt about it. If you look at the technical analysis, the chart looks absolutely wonderful. You're breaking out of a, 2.5-year sideways move, because I think it first hit the $2,000 level back in August 2020. We've finally broken through that convincingly. Underneath this, the moving averages are in bullish sequence. I mean, the whole thing, really, it's absolute technical, textbook bull market, which is great. And the other thing that's so surprising in this is that apart from perennial gold bugs who are always bullish, I mean, let's face it, when things go down, they complain like fury that it shouldn't have gone down. But apart from those very, very few vociferous people, nobody is really long of gold. I mean, it is extraordinary. The only people who are really long of gold, and I think we ought to note this, really are the central banks. They've been accumulating gold, and we need to ask ourselves why. And I suspect also that quite a number of countries around the world have been putting gold quietly into their sovereign wealth funds or into various accounts, which are just basically not visible to the rest of us. So the situation going into 2024 looks to be I think about as positive as you can really get. Now, I wrote about this in my article for Gold Money last week. That was the last week of 2023. And I was trying to make the point, and I think this is a theme going forward. I was trying to make the point that it's not gold going up, it's the dollar going down, or other paper currencies going down. And indeed, if you look at the gold price in sterling, we're not at the highs yet. But that's because sterling has been rallying as the dollar has gone down, if you like, on a trade-weighted basis. I think it's terribly important to understand that the purchasing or the value of gold and its purchasing power generally varies very, very little over considerable periods of time. And any variation in value in the short term is probably as a consequence of shifts in the valuation for the paper currencies in which it's measured. And not only that, but of course, we have a situation where after 52 years of propaganda from the US Treasury, very few people actually understand that gold is money and the rest is credit. And that, I think, is a very important message for everybody to understand going into 2024. Best way to tie in the value of gold in terms of, commodities, products, whatever, is to think in terms of those basic raw materials, because there is obviously considerable variation in the manufactured outcome of the combination of these raw materials. But taking that into account, I would expect to see, as the purchasing power of paper currencies falls, obviously, the cost of consumer items will tend to rise accordingly, and there will be considerably greater stability in their prices measured in gold than in the paper currencies. So that, I think, is certain to happen. The answer to your question is yes, there will be, if you like, a far more consistent pricing in gold than you will see in a collapsing value of the dollar.
During the interview, Alasdair Macleod differentiates between credit and tangible assets while pointing out that challenges are likely for credit encompassing bank deposits, bonds, and equities. A sobering start to 2024 has wiped out hundreds of billions of dollars of value for credit markets caught in one of the worst cross-asset sell-offs to greet a new year in decades. ABA's Economic Advisory Committee, made up of chief economists from North America's largest banks, expects credit conditions to worsen in the coming months. He is concerned about high bank leverage, expecting increased worries as the economy possibly heads into a recession. Jim Reed, strategist at Deutsche Bank, predicts the world economy will flirt with recession in 2024, and the U.S. will suffer a mild recession in the first 6 months, with the economy only growing 0.6% over the year, while the Eurozone is only seen expanding by 0.2% in its second year of effective stagnation. Let's get back to the interview.
I suspect that as the situation develops, gold will begin to, in terms of its value, it will begin to anticipate increasingly the decline in the purchasing power of paper currencies. In other words, it will be ahead of the price effect, if you like, in the supermarkets and, on the forecourts and all the rest of it. But I think we need to draw a very, very clear distinction. You mentioned the word credit. When it comes to anything which is credit, in other words, something that you don't possess, but expect to possess in the future, contractually or any otherwise, it's that credit which is going to be the real problem. So the really nasty consequences are going to be against credit, and credit includes not only bank deposits, not only bonds, which basically are a promise to pay interest plus the principal at the end of a period, and not even equities, because equities are actually credit. What happens is that you part with, call it money, or credit if you like, some means of a company being able to pay its bills in return for a slug of the equity. What is the equity? The equity, effectively, is a perpetual promise to pay you the share of the profits, your share of the profits in the company. So all these things are credit. Credit is the way in which the whole world actually revolves. Looking into the coming months, however, the situation, I think, is going to become worrying again. I mean, you're right in saying that these banks are very highly leveraged. I mean, to give you an example, The risk-based capital ratio of FDIC-insured banks at the moment is around about 14 times, 15 times, something like that. This is not as bad as elsewhere, I hasten to add. But look at it this way. If you've got, if a bank's got a balance sheet, let's say, of $1 trillion, and it's got losses of 10% of that, then it's going to wipe out its equity completely, and some. So that's the reality of the situation. Now, as we go into a recession, people are going to start worrying about this. Now, at the moment, the statistics say, well, what recession? I mean, okay, things have slowed down, but there's no recession. But there is a mismatch between the GDP number, which is basically the amount of credit in the economy, and the purchasing power of that credit. What tends to happen is that the expansion of the credit happens first, probably 18 months ahead of the effect on the price level because of the Cantillon effect and so on and so forth. So saying that GDP's, real GDP is fine, it's looking all right, we're not in a recession. I mean, this is complete rubbish. It just ignores the time lag, if you like, between the expansion of credit and the effect on prices. And I think certainly, I mean, my American friends, when I talk to them about it, tell me exactly the same story that we have in this country. And that is, you go around the towns, regional cities maybe, go around the villages and see how businesses are actually doing. Local business is in real difficulties. It is extremely tough and getting tougher.
The outlook in 2024 also suggests the potential for further gains. Given gold's already high price, a new record in 2024 seems more than possible. A whole range of economic and geopolitical factors could give gold a further price boost, particularly in the latter half of 2024. How do you view gold's role in your investment strategy following potential economic challenges and currency fluctuations? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.